Okay, let's see. Waiting for people to sign on. There we go. Hi, everybody. Welcome to the second session of Money Matters. And I'm just going to give it one more second. We still have people signing in, and then we will get started. All right. I am Andrea Krupp. I'm the Director of Planned Giving and Estate Giving for Providence College. And I am so lucky to be here with two amazing women, Barbara Bolello, class of '94, and Maggie Jondro, class of 2010. And both, this is a very exciting month for them. Maggie is on the precipice of becoming the owner of Jondro Wealth Management. So yay, Maggie. And Barbara is now a partner at Regent Atlantic Capital LLC. So just breaking news and so exciting. So tonight we are going to keep our conversation going about intelligent investing. And please, any questions that you have, shoot them out into the Q&A section at the bottom of the screen, and we will answer them as we go along. No question is silly. This is a place for you to feel comfortable. Shoot it out. And we are all available at any time after this session. Barbara and Maggie, their bios are available on the Planned Giving Providence website, and my information is there too. So Barbara, why don't you set us up for tonight? Tell us what we're going to talk about, and then we'll get started.
Absolutely. Thank you for your kind introduction, and it's always an honor to be a part of this. I know Maggie and I are super excited to be able to share some of the nuggets that we've learned along the way, and some of the concepts and strategies that we talk to our clients about on a daily basis. So it's pretty cool to be with you gals tonight. So thank you so much for having us. So by way of structure for tonight, the plan is to go about an hour. If we go over, that's fine. If we go under, that's fine too. It's holiday season, and I know folks have their minds on a million other things. So we're going to start off, Maggie's going to start off with asset allocation. Then I will go into diversification. Maggie will go back into the program with risk tolerance. And then I will wrap things up with ESG, which is environmental, social, and governance investing. And then we're happy to answer any of your questions. And gals, along the way, please do submit questions, and Andrea will, bring anything to our attention. What we didn't do last time at the beginning of the session is that Maggie and I are subject to pretty severe compliance restrictions, and so we are not permitted to give advice to anyone specifically on any individual investments. So if there's anyone out there who wants to talk separately, we're happy to do it. But unfortunately, our hands are tied from a compliance perspective. So we weren't being cheeky last time about not answering. We just weren't able to do so. So Maggie, anything you want to add?
No, that was a great introduction.
Right.
On the one hand,
you're on.
I will say it's great because that we took all the right exams and we're regulated. So, we are being monitored. We have some credentials here. So.
All right, you're off to asset allocation, Maggie.
Great. So for those that joined last time, we talked a lot about the components that make up investing in personal finance. We talked about ETFs and mutual funds. We talked about stocks and bonds. So just a quick refresher before I run into the asset allocation, because they're related. We were taught a cute little rhyme that stocks you own and bonds you loan. We were reminded that stocks take on more risk, but potentially more reward, while bonds tend to take on less risk, though there is also risk with bonds, and therefore you get usually a smaller return. We talked about different types of accounts. So I think there was a great baking example used that, a brokerage account or an IRA or a Roth IRA or a 401k are the baking pan. And then all the ingredients that you put in are mutual funds, stocks, and ETFs and bonds. And the last thing I'll say is ETFs and mutual funds are baskets of investments. So you purchase them, and within them, there's a lot of stocks and bonds as well. So today we're diving deeper now that we know those basic things. How do we create a portfolio, an investment portfolio that's right for you? And that's what we talk about when it comes to asset allocation. So an asset is just something that society deems as valuable. So that could be your house, it could be your RV, your boat. It could certainly be the cash in your bank account, and of course your investments, including your retirement accounts. So that is what we're talking about today. What are your assets? And specifically your investment accounts, how are you allocating them? How are you investing them? Where are you putting them? So I thought it'd be helpful to share my screen and show you some of the things that we talk about when it comes to thinking about our clients and where we're going to invest them. So I have a fake this is not a client or anything, model on my screen that I'll share right now. And so hopefully you all can see this. It has a lot of colors on it. Andrea's, okay, great. Everyone's not nodding. Okay. So essentially, the first thing I'm going to talk about is right in this corner, and that's the asset allocation. So again, we talked about stocks, bonds. We talked about domestic stocks versus international. And this is what this pie chart tells me. In this situation, about 58, I'm going to use whole numbers and round up, about 58% is in US stock. Then about 10.5% is in non-US stocks, so invest internationally. About 27% is in bonds, the orange slice here, and about 5% is in cash. There's also an other category, and it's so tiny, we'll just skip that for now for simplistic purposes. So generally speaking, this person or this fake person would be about 67% in stock and then 33% in bonds and cash. So this is usually what we'd call a moderate portfolio. Every advisor is going to think a little bit differently about that. And we'll talk a little bit about whether moderate is right for you, aggressive, conservative during the risk tolerance part of the questionnaire. But that's, somewhere on your statements, you'll probably see this breakdown. And that's going to tell you, do I have more stock, or do I have more bonds, or do I have an even mix like we see here? So we're going to go through that next week too. We're going to encourage everyone to bring their own statements, certainly not to share with us, but just to follow along as we present a statement on screen. So then when we think about how else can we allocate, very basically, as you see here, stocks versus bonds, but you can take it a next step and say, well, do I want large companies, medium companies, or small companies? And there are different reasons for all of that. A big reason for your asset allocation in general is diversification, which Barbara will talk about. But you can see in this case, this is the amount that you have in large stocks, so about 76%. Then in mid stock, right below it, we have about 17%, excuse me. And then right below that, we have about 7% in small companies. So again, why would you want to invest in different sized companies? Well, think about it. If we could all have invested in Facebook before it was what it is today, I guess it's called Meta now, we would have quite a bit of money if we invested it when it was a small or mid company. Large companies are going to be the ones that you know of, the Facebook, the Apples, the Pfizers, the J&Js of the world. And mid and small might be something more regional that you know of, or something you haven't heard of. The other things you can consider is, are we in growth companies? So companies that are constantly innovating with new products and their goal is to achieve double-digit growth. Are we in value companies? Those are kind of your steady eddies that have a product that's very consistent. So I like to think of airlines as a value company, or big pharmaceutical companies, or maybe a combination of both, blend. So that's just kind of skimming the surface of different types of stocks you could put your money into. Then we can turn it over to bonds. And that's kind of what you see in this orange section here. So you can have what's important with bonds is duration. So that is the time it takes for you to get your money back as an investor, the length of time. So again, remember, bonds, you as an investor are lending, for example, the government money, and the government agrees to pay back that money to you with a given interest rate. And I apologize, that is my dog, if you can hear it. I'm just going to pause to let him out to make him be quiet.
And just so the audience knows, bonds are her dog's favorite subject. So he gets very excited when anything around fixed income is brought up.
Exactly right. Yeah. So, sorry about that. You can't win. Me and my husband are both on conference calls right now. So anyway, going back to the screen share, if you think about length of time that it takes to repay your bond, there's going to be things that impact whether you want to have a long-term duration or a short-term duration. Another thing when it comes to bonds is you want to think about credit quality. So think about your own credit, right? You have a credit score. There are these independent agencies that give you a credit score. Similarly, there's these independent agencies like Fitch and Moody's that give bonds a score, a credit rating. And so you can have a high credit rating, a medium, or low. And more specifically, again, kind of there's a lot of things on here, but I kind of want to show you different breakdowns because your statements might have this too. You can see that AAA is a very high credit quality. So how much of your bonds are in AAA? And anything below B would be a low credit quality. And then you have things in the middle. So, those are kind of things to think about when you're allocating your stocks to bonds, but then even taking a deeper dive and saying, well, do I want to have stocks that are short-term or long-term or intermediate, bonds, or do I want to have a high or low credit quality when it comes to bonds? Do I want large stocks, small or medium? Those are all different questions that Barbara and I think about when we put together our clients' portfolios.
Maggie, can I interrupt you for 1 minute?
Yes.
Why would someone want a low rated bond?
That's a great question. So often when bonds are rated low, it's because it's usually a corporate bond. It can also be a government bond. Think of some companies that are going through, or countries that are going through turmoil. But when we think of corporate bonds that are rated low, it's probably because they had some financial troubles. But the thought here is, if you do your due diligence, that those companies are coming out of those financial troubles. But because their bond credit quality is low, they have to offer their investors more incentive as to why to invest. So typically low credit quality bonds will have a higher percentage that you get returned. That interest will be higher. So often when I see people look to bonds for safety, saying like, I just want bonds because I think my money is going to be a lot safer than in stocks, they're going to go with higher credit quality bonds or even treasury bonds. But those return a lot less. Right now, treasury bonds are returning anywhere between 1% and 2%. Whereas if you do get a low credit quality bond, sometimes referred to as junk bonds or high yielding bonds, you may be able to get that that higher interest rate, maybe 4% or 5%, and those things change. So obviously anything I'm saying right now, you have to do your own research because they change over time. But that's a really great question.
I have one more that I hope is also a good question. So with stocks, you leave it in the market and it fluctuates up and down. So you could potentially earn a lot of money if you hit the right market, right, and decide to sell. With bonds, the way I understand how you explain them, we're loaning our money and then we are getting paid back at an interest rate. And usually there's a time limit, right? So by, let's say in 10 years, you will have gotten your money back and interest. Is it with a bond, do you sell at that 10-year mark, or is it something that you continue to leave in and it continues to earn interest if you leave it, or does it stay and leaving it just keeps accruing interest?
Yeah, no, that's a great question. You can either, if you're buying a single bond, which by the way, in most 401k plans, you're not allowed to buy single stocks and single bonds. But if you're buying a single bond, you can choose to wait until that date comes where your bond matures, or there is a bond market where people buy and sell bonds earlier. And so again, in your 401k, you're most likely going to have a mutual fund that's going to give the portfolio manager of that mutual fund the discretion to make those decisions about your bonds. But if you were to buy single name bonds, there's both options: waiting until full maturity or selling it early. Another great question. Perfect. So probably
Not bad for a lawyer, 2 for 2.
No, those are really good
questions.
questions. There's a really good question. So kind of probably more interesting to people is, where am I invested, right? What sectors are more in favor and less in favor? So in this example, you can see that right now there's about 16% being invested in the stake portfolio in financial services, whereas only 1.22% is being invested in real estate. And again, this is kind of fun for people because you can just think about, well, what am I buying a lot of now? Or what am I hearing in the news? And so real estate might not be a place that's in favor right now when you think of it because of commercial real estate, right? A lot of people are working hybrid models. So many corporations are downsizing their physical real estate footprint. Though on the flip side, you can say, well, but what about housing, right? There's a housing boom and it's hard to get a house and everything's selling over value. So those are sort of the questions that Barbara and I think about when it comes to sectors where we allocate people's money. You could see technology is another place that there was more money in this portfolio added, about 25%, because, think about what's going to happen over the next 10 years, a lot of growth in the tech sector, self-driving cars, artificial intelligence, so on and so forth. So, that's probably the most interesting part, thinking, where do I think there's going to be a lot of growth? And again, that changes, often, they say that when there's a recession, consumer staples do really well because those, as the name suggests, are items or services or goods that people need no matter what. Even if they've lost their job, you still need to buy paper towels and toilet paper, for example. So that's another way to think about where is your money invested. And probably the last place, and then I'll turn it over to Barbara to talk about diversification, which totally dovetails into this, is also which country are we invested in, which parts of the world? And so you can see here about the majority of the portfolios in North America, but you have some in Greater Europe, about 7.4%, and then you have some in Greater Asia, 6.5%. So, I think there's so much to unpack when it comes to asset allocation. So I'll sort of pause there so I don't put everyone to sleep at 6:30 at an evening. I can get my dog to bark again to wake you up if you want. But what I will say is you'll want to start thinking, what is my mix of stocks to bonds? Then you'll want to think, well, do I want large, small, or big or medium companies? And do I want value or growth stocks? And then you can think about which bonds do I want? High credit quality, low credit quality? What's the duration? And then I would think about your sectors. So technology, industrials, energy, real estate, so on and so forth. And of course, where you're being invested in the world. So lots to think about. But I think if you do come at investing this way, you'll probably find it a lot more interesting because as you can see, there's a lot of things Barbara and I have to think about.
Maggie,
So-
we have one question for you.
Great.
Is your asset allocation illustration age and income dependent?
Great question. I think that there's a lot of things that any asset allocation depends on. One is going to be your age. Absolutely. You know, how soon do you have to use this money? I wouldn't say that this is completely accurate because I think there's more to asset allocation than just age, but there is this thought out there that when you're young, you should be 100% in stock because in your 401k, because you have 30 years before you're going to use that money. And there's certainly truth to that, because if you look at this graph right here, this is the market from 2011 to 2020. And you can see, you know, the market has had ups and downs. Obviously, 2020, a big decline. And you can still see that the market has trended upwards over time. And, you know, there's statistics out there saying that the chances of having an absolute negative return when you look at any 10-year historical period is actually only 1%. Because over time, even if a recession happens, we do anticipate the markets to rebound or to bounce back. So that's why they usually say when you're young, you should be all stock. And when you're nearing retirement or in retirement, you should be a little bit more conservative, which traditionally meant bonds. But you can't be in all bonds necessarily when you're retired. Let's say you're 65, because people are living until their 90s. And so that you have to live on that money for 30 years, and you have to think about inflation and withdrawing that money. And are bonds gonna meet your percentage increase needs or return needs that you need to be able to do those things? So I would say age is a good place to start, but it shouldn't be the only place. We're going to talk about risk tolerance. That's another piece. So going back to my example of saying, well, you're young, you should be 100% in stock. I have some younger clients that because it's not their retirement account and it's just an investment account that they want to use maybe in 5 or 6 years, they're unwilling to be all in stock because they don't have as long of a timeline for that money to come back if there's a market recession. So I would say your timeline is important. And then, like I said, risk tolerance. So like what lets you sleep at night? And I also think, what are your financial goals? So I have a client who has quite a substantial sized portfolio, and she will never use that money. She'll never touch it because she lives very frugally. She's 7 years old, lives very frugally, has a pension and Social Security, and that is enough for her to get by and live the way she wants to live. Meanwhile, I have another client who's younger than her and takes out a lot more out of his portfolio because he owns 2 homes. So there is so much nuance as to how you should be allocated, which is why I actually highly encourage anyone that has questions to speak to a professional. But I would say working backwards is also a good place to start. So thinking, well, I want to have $1 million in retirement. How should I be allocated in order to get there, for example? And there's tools out there that will give you some projections. Obviously, you can't make any guarantees. The past does not predict the future. But again, there's some tools out there with reasonable assumptions that could help you with your asset allocation to get you to that goal, whatever it is, when you're retiring.
Maggie, I want to shift over to Barbara because we could talk forever on this one topic.
Good.
But quickly, there's one more question that if you can just quickly, which benchmark are you using in your example?
A good question, because that's from last time. So that means you were listening. In this case, I'm using a blended benchmark because we basically said, well, there's 57% in US stock, so we'll use 57% S&P 500. There's 10.5% in non-US stock, so we'll use 10.5% MSCI World Index. And there's 27% in bonds, so we'll use 20% in Barclays Ag. So it's a blend, which is probably most accurate in these cases. Certainly you can use just the S&P 500, but know that if you have 11% in non-US stock and 26% in bonds, the return against the S&P 500 wouldn't be completely accurate.
Awesome. Thank you, Maggie.
Yeah.
All right, Barbara, your turn.
All right. So as everyone recalls from the last time I spoke, I love food and I love food analogies. So I'm always happy to weave them into any conversation that I'm having. So let me just quickly address the one point that was asked about the benchmark. Maggie's 100% correct. I agree with her wholeheartedly. It's challenging, and it's really just something that I love for the group to think about. It's comparing apples and oranges, right? So that's my food analogy for the moment. If you have a portfolio that consists of more than just stocks, it's very difficult to expect that your portfolio is going to behave or perform exactly the way that the S&P 500 does. So advisors have gotten wiser in that we really want to give our clients a benchmark to use, but we really need to make sure that we're comparing apples to apples and not two different things, because it really does, it sends people over the moon when they think one thing and then we're showing them another. And so we have to have conversations about it. But if for those of you with advisors, I would press that a little bit to try to see if you can get a better benchmark. So with that, what I wanted to do is I wanted to sort of roll back the tape before Maggie started to talk about asset allocation. How do you get to asset allocation? How do you determine how much of your pie, as it were, again, pizza pie, right? Okay. How much of your pie should be in growth or stocks? How much of your pie should be in fixed income or bonds? And Vivian had asked a question which Maggie addressed around income and age. And so as planners, Maggie and I don't start with the investments. We start with a financial plan. And that financial plan is basically the aggregation of a variety of different components that will enable us to say, well, gosh, Andrea, you need to have X amount of money at retirement. Then you need to have X amount of money for an existing period of time, because we always tell our clients, we don't want you to run out of money before you run out of life. And that's really one of the main focal points of our clients, is to say, well, this is what I've got. How do I get there? And how do I accomplish the objectives that I put forth to you? And so those data points are absolutely what Vivian just said, not necessarily age at the beginning, but age does factor in, because if you are thinking about how much money you need to live on, whether you take money from your portfolio to live on, and if you take money from your portfolio to live on, you prohibit that money from growing. And so when we think about that versus, relying on Social Security, or relying on a pension, or relying on required minimum distributions from your IRA, those are two very different conversations. And so some of the elements to that equation are income, expenses, age, the state that you live in, because most of you guys know that state to state, the income taxes can be very different. A New York taxpayer is not nearly as happy as a Florida taxpayer. We also talk to our clients about to Andrea's point, their philanthropic inclinations. Do they have a will? Do they have legacy planning? When do they want to retire? And to Maggie's point, and she'll get to this, risk tolerance. How much of the seasickness can you withstand over the course of time? And so again, putting all of those elements into software, we use Money Guide Pro, and that is some software that we use as an organization. As part of that, there's a financial independence analysis that we use as the backbone for our relationships. So just some food for thought. As we think about that, it really is a question of having conversations and getting real about the level of risk that you want to take. And it doesn't matter age-wise how much risk you want to, there's no formula, to Maggie's point. It really does matter about, and it's all, one of the reasons I love my job so much is I love behavioral psychology. And most of the time, people would rather not lose money than make 35% a year, right? Because losing money to them is, oh my gosh, I've worked so hard my entire life. I've spent so much time away from my spouse and my kids and really making sacrifices that I really don't want to lose what I have. So I'm happy to preserve it. And I'm also happy for it to grow, but not in a way where it's going to cause me to not sleep in the middle of the night. So again, those are some things to think about. And I'm sure I've forgotten an element or two of that, but I think you can get the gist. So getting back to food, diversification is very, very simple as a concept. All it means is don't put all of your eggs in one basket. And the reason why we say this, and again, Maggie was kind enough to bring us a report that illustrated the variety of different investments that are out there in the investment universe. So with asset allocation, you've got stocks, you've also got bonds. And when Maggie and I say stocks and bonds, those are interchangeable with mutual funds and exchange traded funds, because mutual funds can be equities or stocks. They could also be fixed income. So that's sort of the bigger piece of the pie. If you drill down into the pie, you have different types of geography, right? You could have, and again, Maggie is kind enough to share the screen. You've got global investments, you've got international investments, you've got domestic investments, you've got small companies, you've got big companies, you've got growth companies, you've got value companies, you have real estate, you have alternative investments, which are private equity, hedge funds, and sometimes real estate, sometimes middle market lending. What you're doing there is you're taking one step back to look at your asset allocation to say, okay, and again, I'm going to be 50 years old. I'm happy to share that. My friends and I are calling it the view from the fifth floor. Okay. So at my level, I have 1.5 children to put through college. I plan on retiring in my mid 60s. And so I have my own goals. My asset allocation might look very different than my neighbor's asset allocation, who is the same age, because maybe they have saved more, maybe their expenses are higher. And so what we're doing here is, again, not putting all of our eggs in one basket. We are spreading out the risk across the planet, because like I tell my clients, we never know which way the ball is going to bounce. What I mean by that is, in 2020, US companies knocked the cover off the ball. And I don't know if for those of you who pay attention to the markets, there were 5 companies in particular that did so well that it made the S&P 500 look like a rock star. And those companies were your favorites: Apple, Microsoft, Google, Facebook, right? What they did is they crushed the S&P 500 number. And so it looked like it was doing really well. But as you know, that's only 5 companies, and there are 500 companies in the S&P 500. And you might say to yourself, well, Barbara didn't talk about the other 495. I'm talking about them now. They didn't do as well. Okay. And so the reason why I say this to you is because there are going to be companies that do really, really well some days, other companies that are not going to do very, very well in other days. There are also going to be countries that maybe they have a currency problem, maybe they have a geopolitical problem. And we've seen a lot of corruption in certain countries across the planet. Do we want to put all of our eggs in that basket? No, but maybe there is a vibrant economy behind it. So again, we want to make sure we spread the risk out in the form of diversification. so that people can have a sense as to, again, spreading out that risk, diversifying, and again, not putting all of their eggs in one basket.
Barbara,
So,
quick
yeah,
thing. So
please.
we, I think probably most people on the call have been faced with a 401k, a 403b decision, right? You start a new
Sure.
job and they say, here you go. Here you are. Tell us where you want the money to go. We can either put it in what we consider the bucket we typically do. So this is the default place,
Yep.
which tends to be much more conservative than some people, might want to go. But for the people who don't want to make a decision at all, put it in the default. And then the rest of us look at all these decisions like Maggie showed, and we don't know, right? We might be hearing what's going on in China, what's going on in the Middle East, what's going on in Europe, right? COVID's now going through Europe. We might be thinking, great, Tesla, Facebook, Apple. I can't invest in those. My piddly little money that I'm gonna start buying. Those aren't the stocks that are in my choices. How do I look at that? And it is, first of all, I guess, is a 401k and a 403b retirement fund. Do we have the diversity options that you're talking about? And is that the place where you want to do the same kind of thing, US bonds, non-US allocation? And so this, all these questions, which you can answer now, not answer, or, however. And then the other thing is, do you revisit those with a retirement account every year and say, all I know is that it seems like things are happening more, US seems like a better economy than non-US. Do I change my allocations on an annual basis? Do I let it ride? What do you do with something where it is your retirement fund and you're faced with all of these, and don't always maybe go to your financial planner every year to revisit that? What's a healthy way? What's a healthy relationship with your retirement fund look like?
Absolutely. A great question. And I do think that most companies should have somewhere, somehow, a person or a department that can help you with that. But again, when you look at the investment menu of options, those have been vetted and approved by the company. And the way to think about it is, there is not, that you cannot have any kind of discrimination in any of these retirement plans. And let me explain to you what that means. The investments that are chosen for a 401k or a 403b plan need to be easy to understand. They can't have these exotic, synthetic, single stock concentration, yada, yada. And again, look at all the poor people at Enron, right? Who, when that company went under, do you know how many people at Enron in their retirement plans? That went bye-bye after that happened. And so I think that there's some safety and security in that. What I would do is sprinkle a little bit to as many places as you feel comfortable. I do think that the US is pretty well suited to have a really good year. Not like last year, and certainly not like this year. I think we're going to see some growth pullback, just because how can you sustain this? So again, it's really going to be the investments that you feel comfortable with. Any of these companies that US growth, US value, mid cap, small cap, large cap, I would literally sprinkle a little bit in each. But again, based on your age and based on how much runway you have, you can take more risk as you're younger, as Maggie said, because your time horizon is much longer. That said, old school, if you were getting older, you tip the scales to fixed income. So you would have 80-year-old clients who had 100% in fixed income. Well, guess what? Those clients who are 80 are not at 100% fixed income anymore, because they're not paying anything. And so people used to live off of the interest, off of the yield. You can't do that anymore. So it's important to sort of pay attention to the environment, because again, there's no one size fits all. I hope I've answered the question.
If I could jump in there too, I think not true for everybody, but for many plans, your default may be a target date fund. So I just pulled up one. I don't, I am an independent financial advisor, so I do not work for Fidelity, but just one that came to mind. So every name that's available to you that's a mutual fund will have this symbol, which you could see here. And Barbara talked about that last time. And so you can literally just Google that symbol and you'll probably get something that looks like this on the screen. And while this might seem like a lot at first, there's a couple really easy things to see here. The first thing you'll notice, it says asset allocation. So this fund, this one fund, because it's a target date fund, which means, hey, when are you retiring? The portfolio manager is going to manage this one fund that way based on your age. And again, it's not perfect, especially as you get closer to your retirement age, because it probably will have too much bonds in it, given what they're returning right now, but it's a great place to start. So what this is saying is a Fidelity Freedom Fund 2050 fund. This is saying that this investor is retiring in 2050. So that is, quite some time from now. So the portfolio manager is going to manage this more aggressively right now. And so you can see asset allocation, 53% in US equities, and it kind of shows you what's in there, 41% in non-US, just, about 7% in bonds. And so I would say that this is probably well diversified without digging in too much deeper. Certainly, I would encourage you to do that too. And I think Barbara said it perfectly. There's probably somebody you can call, or there should be somebody you can call, on your plan. But again, that kind of shows you like every fund is going to have something like this. You can look at their monthly fact sheet, which will give you more information. It will even give you a little blurb that says like, what is the goal of this fund? You can see historical performance, which again doesn't predict future performance, but this is all available online to people. So I would say if you have a target date fund and genuinely don't know what you're doing, that's probably a good place to start. But I completely agree with Barbara. If you feel comfortable kind of sprinkling it into everything, because there was due diligence done to already pick those investments.
And for those sort of newer investors, if I can add, those folks who are, in their 20s, they really haven't had investments before, their 401k is probably their entree into the investment world. Pay attention, read a little bit. As you get older and as you start to save money and you start to have an investment portfolio, make sure that your 401k and the money that you've saved and now invested are playing nicely together. Don't have your 401k live on an island. Have it work in conjunction with your own investments. And that's what Maggie and I do for our clients. We don't ignore somebody's 401k because 9 times out of 10, that's where all of the money is, because that's the easiest place for people to save over the course of their life. So again, I hope I answered your questions, Audrey.
You answered all of them really well.
Okay.
Thank you. Just for a time check, it's 6:43. So I just want to make sure
I think it might be a good time to transition, and we're going to work together on the on risk tolerance. So Barbara offered to be my guinea pig and pretend she's a client. And so I will share my screen now. There are different tools that anybody can use. There are risk tolerance questionnaires you can Google and find online. You can certainly ask an advisor what their risk tolerance questionnaire, if they have one. What we use is a program called Riskalyze. Frankly, you can, if you go on our website, I think that you can just take it for free yourself as well. So just offering that up there. But essentially, Barbara, you're gonna see Barbara walk through this, and Barbara, you can pretend to be someone else, right? But how comfortable are you taking on risk? And so my first question, it's gonna be 5 questions that build on each other. And we're just gonna give you a bigger number so that you can see the impact of the market on $1 million. So let's say that you have $1 million in your 401k. So the first question, I'm gonna skip this. The first question is, if you invested your $1 million today and in 6 months opened your account, what is that bottom number that would give you kind of a panic, right? If you saw your money really decline. And the reason we choose 6 months is that when we look at behavioral finance, that's usually when people start flipping out. So you see 1 month decline, 2 month decline. Okay, I have to stay invested. My advisor told me that 6 months, 6 consecutive months of a decline is when people get a little nervous. So Barbara, I'll ask you, do you want to stay here where on $1 million, you'd lose 198? Do you want to go really conservative where the most you would lose in like a terrible market is 40? Do you want to go somewhere in the middle?
I would say that given the fact that this is a 401k plan, I will be 50 and won't dream of taking this out until I'm 72. If I do the math, that's 22 years of market ups and downs that I can certainly tolerate. So I'm very happy to turn up the gas and be as aggressive as possible.
Excellent. And thank you for walking us through your mindset. I think that's really helpful. So you said, let's take on as much risk as we could. So what this is saying to us is, in a really great market, Barbara may open her account and see 20% gain, $198,000. But in a bad market, she might see $198,000 loss. So Barbara, you can't choose your original choice. You could either go to the right, where you want more reward. You can see you're about $100,000 more in a good market with the same risk, or you can go to the left, where you see the same reward, but taking on less risk.
I'm going to go with more reward again, because there is an opportunity for me to also alter my investments in my 401k over time, but as they say, I'm going to let that baby ride for at least 10 or 15 years and see what happens.
Excellent. So I think we only have 2 more questions to go. If you can either pick that same choice, or you could go even more reward, but look at you're taking on even more risk. So would you feel comfortable if you opened your account in 6 months and saw $340,000 on your $1 million investment gone? No, that's kind of where you have to ask that question.
I would not mind, because again, I have a I'm an investment person. I understand how the markets work. I don't have an issue with that. I would have an issue if the market was up and my portfolio is performing poorly. Then that would not necessarily be my choice. It would be, what did my advisor tell me to do?
It's a great point.
Turn up the heat. Turn up the heat.
All right. You get one more chance to turn up the heat if you want. So you can see your last choice was here, and you could go even more. And this is this is all the risk you can take on. So, in 6 months, you might see your 1 million grow to 1.6. Wow. But you also might see your 1 million go down to, just about $500,000. So do you want to go to the right or stay where you were?
I think you know the answer to that.
I do. I think you're going to go the right. So we'll click that. So you can see the logic here that Barbara went through. Okay, what is my age? How comfortable am I? When am I retiring? How comfortable am I with investing? Maybe you all were kind of going through this yourself as I was asking, and then you get a risk number. And again, there's different questionnaires out there. Not everything's going to give you a number. I'm a numbers person, so I like a number. And what this tells me is that Barbara, on a scale of 1 to 100, 1 being super conservative. If you scored a 1, I would say don't even invest, because that's basically cash. Maybe you need something that's fixed, like a fixed annuity or something like that, something guaranteed. Bonds have a risk score of around 30 out of 100 in this program. The US stock, the S&P 500, is around a 70 score. And so what Barbara's telling me is, like, not only do I want to invest, but I am happy to go international. I'm happy to put in some maybe alternative investments. I want to get as risky as I can. So you can see how that exercise worked. And then I'll show you one other thing for the sake of time. It is really, how does this relate to her portfolio? So I'm just going to put in, I don't know, some sort of model portfolio that this program allows me, and kind of show you how that might not be in line with what Barbara wants. So let me quickly do that. And I think we might have a question. Do you want to see that while I pull this up?
Yeah, I was actually just going to suggest that. So we have been asked the question, I am retired and was asked about the fees on my annuity. What is a reasonable amount? That's a fantastic question. And this actually plays well into something that we mentioned in the previous presentation, which is fees and hidden fees. And so what your fees should be commensurate with the risk and the reward that you take. When we've actually seen potential clients bring statements to us that say, I am getting an 8% return on my annuity. And I'm saying to myself, that's great. Now, I grew up with the old adage, if it's too good to be true, it probably is. And so we unpacked this person's statement and we learned that there were 4% worth of fees. So the 8% that he thought he was getting was actually halved by fees. So I'm not going to be able to tell you, unfortunately, what fees should look like for annuities. It depends on what you're investing in. It depends on the product, but do be mindful of what that fee looks like, because again, like mutual funds, if you don't know what you're paying, it is absolutely going to eat into your return. So it really is sort of a best guess.
And I would also say, be mindful of fees, exactly like Barbara said, but also don't only look for the lowest cost investing, right? Because I had a client who said, I only want ETFs because they're so low cost. And so his portfolio did fine. But then he said to me, is this like the best portfolio we've ever put together? And I said, I'm going to be honest with you. No, you limited me to very low cost ETFs. Whereas I actually have some actively managed mutual funds that are a little more costly, but they're performing better. So same thing with the annuity, what are you getting for that? I mean, if you're the type of person that is like, I am so happy that I'm getting a fixed rate and it's something that I locked in 20 years ago and I'm getting 6 or 7% fixed rate, maybe it's worth keeping that annuity, because today fixed annuities are returning like 1%, but if you're not, but I guess you have to understand what you're getting for your fee. And sometimes it's worth it and sometimes it's not. And if it's not, understand with annuities specifically, there might be surrender charges. So if you leave the product too early, you'll have to pay a fee for that too. So before you decide to get rid of it because of fees, understand what that consequence might look like too. But if you're past that point, you can always move into another annuity that's better for you, or even an investment account. So
Maggie, before I knew you were going to move into another example, but I just want to point out we have 10 minutes left in the hour. If Barbara, I don't know where you want to fit in the ESG. If we have time for both, perfect. If you want to modify it, it's up to you guys. Just wanted to point out the time.
Absolutely. Maggie, I don't know what you wanted to show the group, so I'll follow your lead on that.
I think it will just take me 2 minutes. So why don't we do that, and then we'll go ESG wise. Okay. So now that Barbara kind of did her risk tolerance questionnaire and the portfolio was created for her, you can also say, well, how would this portfolio have performed in the past? And am I comfortable with that? So you can just see here, we have 3 different portfolios. We have the current portfolio, which I have $10,000 invested in. I apologize, that was the default. I was hoping to use $1 million. And you have the S&P 500, and then you have a very conservative portfolio, a risk score of 24. And you can see in a really good market like 2013, that was a really incredible market. That's what we mean by bull market. The S&P returned about 32%. You can see this current portfolio, frankly, underperformed the S&P a little bit. So you might want to ask your advisor why. And then this conservative portfolio only returned about 7%. So obviously, if you have a fear of investing and your risk tolerance is really low, maybe to you say, yeah, 7% is still okay for me because I know that I am not going to suffer as much losses in a downturn. But again, you can't say, well, why didn't I get 32%? These people up here, these 2 portfolios are taking on more risk. And to kind of show you the opposite, financial crisis of 2008, you can see October 2007 to March 2009, you can see the S&P 500 was down 53.5% during that time period, whereas this conservative portfolio was down only 11. So this is a great example of risk tolerance, because if you can't stomach 53%, then this conservative portfolio might be right for you, right? The last thing I'll show you though is that investing over time, staying invested even during those hard times, is really important. So let's say a recession comes and you're like, gosh, that made me feel so bad. Don't use the recession as time to move in your investments. Wait until the market bounces back, and then maybe make your portfolio more conservative for the next recession. The worst thing you can do is sell out of your investments when they're down. And frankly, historically, over a long period of time, the markets come back. So again, we're starting October 2007, right before the 2008 financial crisis. And all three portfolios, if you had stayed invested all the way to December 2021, you can see all of them would ultimately be in the positive historically. So I'll turn over to Barbara to talk about ESG investing.
Maggie, that was fantastic, by the way. It's
Thank
nice
you.
to see the illustration and get a live example. So there are 4 minutes left. I am going to do an intro or a teaser to what is known as ESG investing. E, environment, S, social, G, governance. For those of you who are familiar with the topic at all, there is another option called SRI, socially responsible investment. They're trying to do the same thing. And that same thing is making sure that companies are being good stewards. For the E in environmental, one thing you can think about is criteria. What is your carbon footprint? What companies are leaving a mess behind? The next is social. And what that means is, how are companies treating and working with their suppliers, their providers? Are they only working with one look of a person, or are they looking to work with people who are more diverse? On the governance piece, what that means to me is, what does your board look like? Do you have women on your board? Do you have older folks on your board? Do you have younger folks on your board? Do you have people who are known as more diverse candidates? And so we talk about things like leadership, executive pay, etc. What environmental, social, and governance means, and this is incredibly attractive to millennials and very, very attractive to non-for-profits, because what it enables those segments to do is to really put their money where their mouth is, to express how they feel about things. And so we were talking in preparation for tonight, Andrea, Olivia, and I, and we were talking about the fact that money has a lot of power. And what we're able to see through these types of things are proxy voting, right? Is a particular company destroying the environment? Is a particular company not very DEI friendly? Shareholders can now take their vote and make a change. Shareholders and purchasers can go ahead and change things with the simple push of a proxy button. So the way that I want you guys to think about, and again, I'm conscious of the time, environmental, social, and governance essentially is a way for you to invest, again, the way that you want to, with a certain level of responsibility. Socially responsible investing is a little bit more specific. It typically eliminates what is known as the sin stocks, right? Alcohol, tobacco, firearms, munitions. What the ESG audience has come to recognize is, why would we eliminate companies who are potentially classified as a tobacco company? Why would we eliminate them from portfolios when they are potentially doing good? And the one example, and I was saying this to Andrea earlier, is I love Coca-Cola. Coca-Cola is a food. Again, Coca-Cola is absolutely a soda maker. They have been, there's been attribution to diabetes and obesity, right? So you might say, oh gosh, Barbara, I don't want that in my portfolio at all. Well, at the same time, Coca-Cola is also furnishing water to countries in Africa. right? So should we continue to penalize Coca-Cola? Are they trying to improve things? Yes, they really are. And so what they're doing is we want to reward them for doing good. How do you know what is a good ESG company? And again, I know there's it's 7 o'clock now. There are a variety of different providers that score these companies. So it's like any quiz, right? Any questionnaire you might fill out. How many women are on your board? What is the diversity equivalent in or diversity representation in the suppliers that you work with? What are your environmental numbers? And essentially these companies, MSCI is one of them, Sustainalytics is one of them. The other one is ISS, Institutional Shareholder Services. All of these organizations are out there and they're screening companies and they're coming back with scores. Each one of these 3 organizations has a very different ranking of scores. So if you're interested, look up Sustainalytics. I think Sustainalytics is terrific. They will tell you, let's say it's 1 to 100. If your company has a 90 and an ESG score, that's probably right up your alley. And if you're ESG conscious, that's probably a company that you want to be invested in. So I will stop there. Unfortunately, I didn't get to everything I wanted to cover, but I think that those sound bites are enough. Again, it is an opportunity for folks to, again, put their money where their mouths are, or people say put their money where their values are. I think that's a little strong, but that's what people have been saying. So I hope that's helpful. Happy to answer any questions that you guys might have. Again, I know it's 7 o'clock, so conscious of time.
And Barbara, I think that that was a really nice introduction. Maybe in the next session, we can pick up a little more on the ESG,
Sure.
SRI differentiation and give some examples of of what that looks like and how do you vote a proxy? What does that
100%.
mean? And so everybody, I think everybody on this call will be joining me in saying thank you to Barbara and Maggie. And I'm honored to be part of the group with you. In the background, Olivia Ferry and Lauren Felix are members of the Providence College crew who are my security blankets. They make sure that my camera's working, my audio's working, that I don't panic when something happens technologically. So thank you, ladies, for being with us again today. We do have one more session in this Money Matters series. We'll be talking about philanthropy and estate planning. And again, we'll follow up with the ESG piece as well. Kathy Entwistle was our 3rd panelist. She was unable to be with us tonight, but she is a rock star herself. So we will be looking forward to having her back. I want to wish you all a Merry Christmas, whatever holiday you celebrate during this time of year. May you be blessed and your families be safe. Thank you all for joining us, and we'll see you in the new year. God bless you all.
Thanks, everyone.
Christmas. And go Friars.
Go Friars.
Right.
Thanks, gang.
Bye, everybody.
Bye-bye.